How long can the party last? Does it have to stop? I don't know. Anyone who says they know, they don't know. Everyone's scratching their heads. I want to share with you this article I was just reading this morning from Advisor Perspectives. Federal holdings of U.S. Treasury bonds as a percentage of bonds outstanding. And so we're going to go back to 2008. I'm not quite sure why we're only going back to 2008. But right now, the federal government owns 25% of all U.S. government bonds outstanding. I guess, yeah. So federal holdings of U.S. Treasury bonds as percent of bonds outstanding. I guess that's Treasury bonds. So the federal government holds 1 out of every 4 bonds outstanding, essentially. That makes sense. U.S. bonds outstanding. All right. If the government intends to spend at an increasing greater rate than tax revenue growth, which they have been right here. So here's the government spending up 210% since 2007. Here's the tax revenue up 31%. A new funding source is required. Traditionally, Treasury debt funds the deficit. Debts fund the deficit. The deficits are the addition to the previous debt. The problem with relying on debt is that progressively larger debt loads push interest rates higher, complicating the situation. Enter the magician. Since 2008, the federal government has helped fund the deficit via quantitative easing. The Fed now holds nearly a quarter of all outstanding federal debt. It is as if $5 trillion of Treasury debt was never issued. The Fed also has another $3 trillion of mortgage agency and corporate debt. The federal combined holdings of $8.25 trillion significantly reduce the supply of debt waiting on the markets, keeping interest rates artificially low. So this is what's funny. The problem with relying on debt is that progressively larger debt pushes interest rates higher. But yet the Fed's combined holdings of $8.25 trillion significantly reduce the supply of debt that's outstanding, because the Fed just says we're going to put it in essentially Fort Knox and you can't touch it, but it's still out there. Weighing on the markets, keeping interest rates artificially low because they're a new buyer in town. The Federal is buying up the debt. When the price of the bonds go up because the federal governments get involved, the yields go down. That's exactly what's happened. Hold on a second. All right, so let's keep reading this. Currently, the government's interest expense is less than 8% of total expenditures. That is the lowest percent since 1947. Total federal debt has risen 8,320% since 1966. Federal debt to GDP is 127%, up from 40% in 1966. Interest expense declined by $46 billion, even as Treasury debt has rose by $7 trillion over the last year. Again, debt to GDP is up to 127%, up from 40% in 1966. 40% in 1966. Total federal debt has risen 8,320%. Yet interest expense has declined by $46 billion as the Treasury debt rose by $7 billion. And this is the lowest percentage of interest expense, is the lowest since 1947. Federal debt to GDP is 127, up from 40% in 1966. Hang tight, we're going to show you something. All right, so in 1966, when the debt to GDP was only 40%, inflation was 2.9, 3.1 as is going up the next year, 4.2, 5.5, 5.7, 6, 11. So as debt to GDP is going up, so is inflation. Inherently, that showed you that debt to GDP rising means inflation is rising too. Oh, but then we start going back here. 4.3, 3. This is like the retirement spending smile upside down. Turn that smile upside down. We had lower inflation, high, and then it starts dropping off a cliff. And we go back, inflation is basically nothing now. I mean, how do we change that date here? 1 sec. Can I change this? There we go. Let's change it to 2019. And we're going to see. Okay, I don't know how to do it. But anyway, whatever. We can see that inflation, we know inflation is there's a big nothing burger now. So in 1995 is at 2.6, even though the debt to GDP is going through, I got to change this. One sec. Oh, am I boring you, Finnegan? Sorry to bore you, dog man. Don't let your daddy bore you. Here we go. And so here's inflation, 1997, 2.3, negative, 3.8, 3.9, 2.9, 1.6, 0.01. In the 1% here, I mean, so how do you square that circle that as debt to GDP was going up and is now at 127? Inflation did not go up with it. It did for the first couple decade in the 1960s, latter part of the 1960s into the early part of the 1980s. But the debt to GDP is still going through the roof, and then kaboom, the inflation rate's gone down. On top of the federal government is borrowing money like drunken sailors. We all know this. So there's no if this happens, that will happen in terms of debt to GDP, causing higher inflation. And so, I mean, again, the amount of debt, let's see, the problem with relying on debt is that progressively larger debt loads push interest rates higher, but they haven't pushed interest rates higher. And you could say because the federal government is pretending like $8.25 trillion of debt doesn't exist, but okay, it's still only 25% of the total federal debt load. I don't get it. So anyway, the cost of the magic. Fed magic allows for cheap funding of deficits. What could go wrong? Well, unlike I don't know what he says. Unlike the Fed can monetize federal debt pushing interest rates even lower. As we see in Europe with negative interest rates, there are no limits to this madness. The problem is the Fed magic comes with a cost. For starters, savers, including a large chunk of baby boomers and retired people, must take on inappropriate levels of risk to compensate for zero interest rates on their cash. That's it? I mean, look, maybe, but huh? I don't get it, man. So aggressive monetary policies funding immense fiscal spending will only widen the wealth gap and further slow economic growth, as is done in the past. What? I mean, we had no economic growth in the 60s and 70s. I don't understand. At the same time, we certainly had economic growth in the 80s and 90s when the debt spending was going through the roof. I don't understand that. At the same time, said policies drive more people to seek shelter from the rapidly devaluing dollar. Was the dollar devaluing? So check this out. I mean, going back to 2006, this is the total weighted U.S. dollar index. It's not devaluing. It's not rapidly devaluing. It's not. Then you look at it right here. Here's the U.S. dollar to the Canadian loonie or whatever it's called. I mean, right here at September 2011, it was basically 1-for-1, 105-1, and now it's $1 is 26% higher value than the Canadian. Now you can look at the dollar versus the euro. Let's look at the dollar versus the euro. The euro is still more valuable. It takes $1 to get 85 cents of euros. And if we look at the chart here, let's see what this looks like. I don't know how you can make a case as rapidly devaluing though. So we're waiting for the chart. Let's go back to 10 years. I mean, it hasn't rapidly devalued. I mean, right back in 2011, the dollar was trading at 72 cents. So $1, it took $1 to buy 72 cents of euros, and now it takes $1 buys you 85 cents of euros. It's not rapidly devaluing. I don't understand that. So it's just weird to me how we keep making this. Let's look at the yuan, and let's see if we can find the yuan here. Chinese, right there. 640. Let's see that chart. So $1 buys $6.44 of Chinese yuan. Go to 10 years. I have no idea. So, oops. They can't let me do it. I guess I got to pay for it. Let's see if it lets me view chart. There we go. 10 years. Yeah, I mean, it's just not rapidly devaluing. Is $1 bought 6.39 of yuan, and now $1 buys 6.48 of yuan. Just how do you say that's rapidly devaluing? And what else I guess you could look at the British pound right there, and that's going to be more value than ours, but you can't say it's rapidly declining. I don't understand. I just literally don't get this. Look, it hasn't. It just hasn't, man. All right, so here, part-time with this, so policies drives more people to seek shelter from the rapidly devaluing dollar, but it hasn't. Speculative investments will further dominate, leaving less capital for productive investment. Productive investments build economic growth and help everyone prosper. Ignoring history and logic may be expedient, but it only aggregates our societal and economic shortfalls. For more on why the Fed's antics to push interest rates obscenely low are damaging, you can read this here. But I mean, who's to say that if the Fed has 50% of federal outstanding debt, that'd be a bad thing? I mean, I don't know. Just because I don't get it. No one knows. Anyway, I wrote in this as a comment here. I said, so we're going to read what Michael wrote. At the same time, said policies drive more people to seek shelter from the rapidly devaluing dollar. Speculative investments will further dominate, leaving less capital for productive investments. So we see what here, let me just read what it said. Productive investments build economic growth and help everyone prosper. And I said, I've never understood folks who imply speculative investments are somehow not economic growth investments. I withdrew $130,000 to fund my business in 2017. $100K startup money, $30,000 to the IRS and taxes and early withdrawal penalties. Was that speculative? Sure. Did it lead to economic growth? Absolutely. I'm paying a hell of a lot more in taxes now than that $30,000 I paid then. People moving a portion of their portfolio from a traditional New York Stock Exchange stocks to other investments isn't necessarily a GameStop meme. There may be speculation. That's not mutually exclusive with economic growth. Anyway, I don't know how long this can go. No one does. This idea that the party has to stop. Why? I don't know. You don't know. No one knows. I mean, they keep saying because the Fed can't keep printing debt. And you're like, well, why? Why can't they keep printing debt? Well, because there's not going to be anyone to borrow. We're borrowing it from ourselves. I mean, look, I don't know. I'm just as concerned as you are, but I'm sitting there thinking, I've yet to find a good reason to say this can't happen. Like my man, this guy right here, he wrote a comment. That's where I got this chart from. Perhaps the dollar remains the best dirty shirt in the closet, 100%. And maybe the human spirit of cooperation forms the limits for maintenance of the underlying trust. I don't know what that means. But anyway, I'm just sitting there thinking, and I've said, what's the alternative? And I don't know the answer. It's not like we're the only country printing debt, man. I mean, let's look at the Japanese. Did I already look at the Japanese? Hold on a sec. Let's look at the dollar versus Japan, the yen. So let's look at the yen. I don't think we looked at the Japanese right there. All right. So again, look at that. The dollar, I mean, it's just over since 2014, the dollar is not devaluing. How do you explain that? And if it's not devaluing, then you've got to go and say the rapidly devaluing dollar. I mean, I don't, let's see. It doesn't make sense to me. I don't know the answer to this. I don't know the answer. I just don't know why it's necessarily, if you have inflated assets through treasury debt, which say, I can't get enough of the interest, so I'm going to go buy some speculative investments, i.e. a piece of business, investing in a business, investing in some real estate. I don't know why that's speculative and inherently a bad thing. I don't know. And you don't either. No one knows. That's why you got to be hedged against everything. I'm telling you. All right. And when I say hedge, I'm not saying buying puts. I'm saying you have diversified areas of your investment portfolio. Love to hear your thoughts. Thanks.